Hello, everybody. Welcome to yet another Saturday webinar. I'm here with my friend and guest speaker, Dummy McPuppet. He's ready to have fun and to look at slides and eat popcorn and learn about spousal limited access trusts. So I'm going to take the slide deck. Before, though, if you're a CPA or a sadomasochist, please consider joining me at the Florida State University Accounting Conference on May 13th. This will be web-based. Don't go to Tallahassee, you'll be disappointed. And then I'm going to be talking on creditor protection for CPAs and fine-tuning and improving estate and asset ownership planning. And I think as a warm-up for that, next Saturday at 11 a.m., I'll be talking on fine-tuning and improving estate and asset ownership with a view towards estate tax protection. If you are not a subscriber to our Thursday report, you probably want to keep it that way. But the Thursday report is free, and if you're not receiving it, we'll be glad to send it to you. We send it on Thursday and on Saturday, and I was very proud of this week's Thursday report. The IRS released some tea leaves on PPP loan forgiveness deductibility. And we've had a recent Florida fraudulent transfer decision that is pretty interesting. And then we've got the President Biden's executive order on Russia, which basically gives the federal government a lot of power to seize assets of individuals who may be doing business with Russia or maybe did business with Russia. That's a lot of power to give a federal agency, and there's some concern there. And Howard Fisher, a very well-known international law expert, wrote a nice memo that's in there. And then this article on SLATs that you'll see today. Now, we do like to do a lot of speaking, so please support those people and causes that allow us to speak if you would, or don't support them if you don't like us, I guess. But I hope you'll all meet me in Birmingham, Alabama on November 4th, where I'm going to talk on hot topics in estate tax and creditor protection, but I don't think it's going to be that hot in Birmingham in November. I'll have to bring out my actual coat, or I'll have to buy one. So next Saturday, I'll also be handling more questions and answers on estate tax planning. What is a SLAT? A SLAT is a Spousal Limited Access Trust. It's a fancy word for a very old vehicle that should have been much more popular in the past, but has become very popularized for good reason. So I can form an irrevocable trust, and the trust can have my wife, Marcia, as the trustee. And the trust can permit Marcia to receive anything she would want to maintain her standard of living. And we use these magic words that date back to English common law before 1776, which say that she can receive what she reasonably needs for her health, education, maintenance, and support. HEMS, the HEMS standard. Remember the Battle Hymn of the Republic, because that is the language they used at that time. And the common law of England says that if somebody creates a trust for you and you are the trustee, as long as you are limited to receiving what you reasonably need for health, education, and maintenance, your creditors cannot reach into that trust, even if you also have the power to spend the assets or give the assets to other people, like your descendants, and even if you also have the power to direct where those assets go when you die, with the possibility of even redirecting them so that they would be for my benefit if Marcia were to predecease me. So that is a very, very liberal law. And when they passed the federal estate tax law back in the 1930s, they dated it back to pre-1776 and said, basically, if a creditor can't reach it because it's limited to health, education, and maintenance, and you received it from someone else, then it is not going to be subject to estate tax either, as long as your power is limited to what you need and your power to direct it after your death cannot be exercisable in favor of yourself, that's the spouse, the creditors of the spouse, the estate of the spouse, or creditors of the estate of the spouse. And that is the main language that you will see in a SLAT. I give to my spouse as trustee the right to receive what she needs for health, education, and maintenance, and the right to direct the trust assets on her death to anyone but herself, her estate, her creditors, or the creditors of her estate. Now, I take $1 million and I place it in this trust, and I file a gift tax return, and I've used $1 million of my $11,700,000 estate tax exemption. So what? Well, Marcia and I plan to live at least 30 years. We're in our early 60s. So if the value of this account doubles every 10 years, which would be based upon a 7.2% rate of return, which is about what our investment portfolio has averaged in the last 30 years, then in 10 years, there will be $2 million in that trust. In 20 years, there'll be $4 million in that trust. And in 30 years, there'll be $8 million in that trust that will pass estate tax free. Now, who pays the income tax on that trust? We do. Under the present estate and gift tax law, we are able to pay the income tax on behalf of a trust that has certain language, certain characteristics, and that's not considered to be a gift. So if you have a 30-year life expectancy, and most of the people on this call do, multiply what you put in this trust by 8 times for the probable value of the trust assets in 30 years, or multiply it by 16 times if you have 40 years. So now you can see why a married couple that has, for example, $10 million in assets. This was a conversation I had with a client yesterday. He and his spouse have $10 million in assets. They are in their early 60s, and they have income above and beyond that. Well, they're way below the 22 million or the 23 million that exists today for estate tax purposes. But that only goes up by chained CPI. It doesn't go up by the consumer price index. It goes up by about 2/3 of the consumer price index. And it's scheduled to come down to 1/2. So it would come down to about 11,500,000 per couple in 2026. In the meantime, his 10 million is going to grow to 20 million in the next 10 years, and then to 40 million, and then to 80 million. So it will greatly surpass. But what if he just puts 2 million of his 10 million into a SLAT? Now his 2 million doubles to 4 million, doubles to 8 million, doubles to 16 million outside of the estate tax system. His 8 million doubles to 16 million, doubles to 32 million. He still has the issue, but the SLAT is a really good vehicle for that. Now, if you set up the SLAT, there's a few things to think about. One, who's the trustee going to be? Well, typically it's the spouse, but if and when you would like to what we call turn off grantor trust status, that means no longer have to pay income tax on the trust income, then the spouse will resign as trustee at that time, and you can decide who the alternate trustee is going to be. Number 2, the spouse has the right to receive amounts as reasonably needed for health, education, maintenance, and support. Okay, number 3, I can be a possible beneficiary if Marcia sees fit to name me later. as long as there is no pre-existing agreement that she do so. That's easy for us because we never agree on anything. And some states, like Nevada, even have a law that says that you can't have an agreement when you do a trust if the agreement is not completely in writing. Number 4, if I set up this trust for Marcia, Marcia is not going to set up an identical trust or even a similar trust for me. Number 1, because Marcia doesn't like me and would not do that. But number 2, because of something that goes back to the British common law called the reciprocal trust doctrine. If I set up a trust for Marcia and she sets up a trust for me, if that may be looked at as if I set up a trust for me and she set up a trust for her, the trusts are uncrossed, then our creditors may be able to reach into them. And then if our creditors can reach into them, the IRS can include it in estate tax. And why is that? It's because if I set up a trust for Marcia, then my creditors can reach into that trust, then I could run up a lot of debt and benefit by having the trust pay the debt. So we have to be very careful when we set these things up. Number 5, the trust will be disregarded for income tax purposes. So the settlor can pay the tax on the trust income. Now, what Bernie Sanders' proposed Senate bill says is that if you've got one of these up and running, if and when Bernie's bill would ever pass, then it's okay, it's grandfathered, you can continue to pay the tax for your beneficiaries. But if you set one of these up after Bernie's bill would pass, then it would have to be included in your estate for estate tax purposes unless the trust pays its own taxes. And by the way, Bernie Sanders and I are not on a first name basis, but I really like him for his tax proposal. It's made us very busy. Number 6, I could put $20 million in a trust for Marcia. If any of you would send me $20 million, I will be glad to put it into a trust for Marcia. And I can use my $11,700,000 exemption, and then I could use her exemption. We could actually file what's called a split the gift return or returns, and then we would use 10 million each of the exemption, as long as she is not likely to benefit from the trust because she's going to get so much money from her next husband. So just think about splitting the gift. Most people are not going to split the gift. Usually the SLAT is formed by the spouse who's expected to die first. Usually that's the older spouse or the male spouse or the working spouse who is less concerned about running out of assets than the younger spouse who may not be working. But if I do a $10 million gift to a SLAT, should I split the gift, 5 million me, 5 million Marcia, or should I keep it at 10 from me? And the answer is clearly keep it at 10 from me. Why is that? Because then if the estate tax exemption goes down to 6 million, I'll have $1 million left and Marcia will have 6 million left. No, I'm sorry, if I use all 10, I'll have 0 exemption when it goes down to 6, but Marcia will have all 6. But if we use 5 each and it goes down to 6, then we'll only have $1 million each. If you understood that, then you're a CPA, a tax lawyer, or at Mensa. If you don't understand that, I am writing an article right now called The Mathematics of Estate Tax Planning that I'll be glad to send you along with 2 Tylenol. Number 7, what if assets used to fund the trust have recently been owned jointly? So let's say that Marcia and I have a joint account with $10 million in it, full of equities. And then we also have a separate account with $10 million of bonds. Okay, now I want to put the equities in a SLAT. I could trade the equities for the bonds. And then I could put the equities in the SLAT and keep the bonds in Marcia's name. Now, what happens in the event of a divorce, which Everyone needs to at least be a little bit concerned with that, especially if you leave the cabinets opened at night, or worse, the garage door. So you should always lock the inside garage door in case you keep the outside garage door open. And I keep forgetting that. So I set up a SLAT, I put 10 million in it, and I let Marcia keep $10 million of municipal bonds. And then I leave the garage door open 2 nights in a row and the cabinets. She divorces me. What happens? Well, if the SLAT is written in a way that allows trust protectors to amend it, and they're on my side and not her side, then the trust could be divided equally. Alternatively, the trust can have language that says, in the unlikely event of divorce. By the way, we always put the words unlikely event of divorce, even if it may seem likely to us. In the unlikely event of a divorce, this trust will turn into 2 trusts. One will continue to be a SLAT for Marcia, and only Marcia will decide who the trustees will be of that trust. The other trust will be for our descendants only, and only Alan will be able to determine who the trustees of the trust are. Now, if the trust is formed in an asset protection jurisdiction, such as Nevada, South Dakota, Delaware, or Alaska, we are able to put a provision in the SLAT that says, in the unlikely event of divorce, Alan could be added as a beneficiary to the half trust that he indirectly controls by naming the trustee if his net worth ever goes below a certain reasonable level, or he ever has the need for funds. So basically, in the event of a divorce, my half of the trust is held for our children. By the way, not the next children. I could have a floating spouse clause in our SLAT, which would say, in the unlikely event that Alan and Marcia get divorced, the half of the SLAT that Alan can name the trustee of can benefit Alan's future spouse. So I could put that in the trust. Marcia probably would not want to see that in the trust. So we don't put that floating spouse provision in the trust. But when we have a single person or a wealthy person on a second marriage set up a trust for children or a SLAT, we will typically put in a floating spouse provision, which says, in the highly unlikely event that the grantor divorces this wonderful spouse, if the grantor, in the unlikely event the grantor remarries, then the new spouse will be the beneficiary of health, education, and maintenance, in which event the half of the couple's living expenses may be paid by the SLAT. So that answers number 9. Number 8 is the limited power of appointment. That's where Marcia would have the right under the trust to direct how the trust assets would pass upon her death, usually limited to our descendants, or at least descendants of my parents, so that it doesn't go to someone we never met. Sometimes she can appoint to charity, but then we would typically limit the annual charitable appointment so that nobody gets carried away with a charity that may in reality be taking advantage of anybody. So those are important points to cover. Now, for you tax lawyers who draft these trusts, I have some sample language, and for those of you who read these trusts or enjoy reading things or have the need to sleep at night, there are provisions we have here. For example, on page 13, Lucky 13, let's say that I put $30 million into a limited liability company, which means one of you needs to send me $30 million, and if you do, I will put all 30 in a limited liability company. I will be the 1% member with voting rights. I'll be the 99% member with non-voting rights, and I will transfer that 99% limited liability company interest about 30 days after it's funded, to avoid the step transaction doctrine, into a SLAT for Marcia. and I will fill out a gift tax return and report that as a $20 million gift because of discounts, which Bernie Sanders is going to do away with if he has his way. So I want to get this done before the Sanders bill would ever be passed, or even actually proposed from the House Ways and Means Committee. Because tax law usually, like 95% of the time, becomes effective back to the date that it was proposed by the House Ways and Means Committee. That's the House of Representatives. So anyway, I get my 99% transfer done. I report that to the IRS as a $20 million gift. They come and knock on my door because they're well funded. President Biden wants to get them funded so they can come knock on your door again. And they say, you know, we read your gift tax return. We saw your valuation report. We think it's a $25 million gift. You owe us about $1.5 million in gift tax. No, I don't, because I have a special clause in my trust that says if I accidentally give more than the gift tax exemption amount, it goes to a separate marital deduction trust. And in addition, I have a valuation adjustment clause in my assignment document, which says that if it turns out that what I'm giving to the trust is worth more than the $23,400,000, the excess doesn't go or may go to charity. So again, I apologize, this is long-winded, but make sure you have the overflow language like this in the SLAT if you ever need it, and make sure you use a valuation adjustment clause like I'm showing you here. So now some common mistakes relating to gift splitting are here on pages 17 through 20. I won't go through those except to tell you that they are here. I've given you a sample divorce clause on page 24. If you're interested in getting divorced, I recommend that you read this clause, maybe even read it out loud. Maybe it will expedite that divorce for you. Now, page 27. This is, I've shown this many times before, but I think it bears repeating because it works well and it involves a SLAT. So I have $20 million worth of assets in here in a limited liability company. The limited liability company on day one is owned 1% by the married couple as tenants by the entireties, and 49.5% by client one, and 49% by client spouse. So client puts some assets in a SLAT. In our example, the client would put about $700,000 worth of cash or marketable securities in the SLAT. And then after that, and about 30 days after this LLC has about a $20 million value, the client sells the 49% non-voting member interest in the LLC to the SLAT in exchange for a $6,930,000 promissory note that assumes about a 30% valuation discount, and the promissory note bears interest at about 1.85%, which is the applicable federal long-term rate. So what have I done? First of all, I've taken a $10 million asset and I've reduced it to a $7 million asset. Secondly, the future growth inside this LLC is not going to be in the client's estate. And third, the client can pay the income tax for these assets without this being considered to be a gift. So I'm freezing the value of the client. Even though they live in South Florida where it never snows, they have frozen their assets. Now, I've got the client spouse. The client spouse does the same thing, but with a trust just for the client's descendants, although the client may be added to that trust if there's ever unforeseen circumstances that occur, and trust protectors who might add the client to the trust. That assumes that the trust is set up in an asset protection jurisdiction. So what happens 10 years later? They're not divorced. They're still happy. One of the main reasons they're happy is that their $20 million portfolio grew to $40 million. The note is still owed for $6,930,000. Let's say they dissolve the LLC. They get $20 million from the LLC, goes to this nice trust. It pays the client the $6,900,000 note. $13,070,000 remains. So $26 million is out of the estate tax system, and $14 million is still owned by the client and spouse. That is a very happy ending, and they didn't have to get divorced to have this happen. Now, for the technical people and also for clients watching, why might you need 3 trusts? The answer is because under the estate and gift tax law, there's an Internal Revenue Code section 2036A. And 2036A2 says that if you give something away, but you control if and when someone else may receive it, then it may be considered as owned by you for estate tax purposes. So in a now famous tax court case called the Powell case, the tax court said that because Mr. Powell's son-in-law had the right to decide when Mr. Powell's partnership would make a distribution, the assets were considered as owned by Mr. Powell. Now, the son-in-law was on Mr. Powell's power of attorney and on his revocable trust as trustee. So when the son-in-law had that power, the tax court said that that was the same as Mr. Powell having the power because the son-in-law had a fiduciary duty to Mr. Powell. So we don't agree with that, and we wish that the case had been appealed. But to be safe, you can set up a simple irrevocable trust, maybe for grandchildren, have someone different than your other trustees be the trustee, have it own 0.1% of the LLC, and give that trust the exclusive right to decide if and when there will be a liquidation or distribution from the LLC. So we call that a special voting member, and that's what it's about. The interest rates that you can use as of, I believe this is current for today. If you do this month, you can use a 1.62% rate on a promissory note more than 9 years. Typically take the note to the client's life expectancy. If I expect that I'll live at least 30 years, then I'm going to do a 30-year note. Now, what happens when I die with a 30-year note paying me only 1.6% interest? Well, the note can be valued at a significant discount. I don't know about you, but I would not pay a lot for a privately held promissory note from a trust I formed that only pays 1.62% interest for 20 or 25 years. There's a very good recent article on that in the Bloomberg Journal by Professor Jerry Hesh. I'll be glad to send you a copy if you like. Now, if I'm not in very good health, I could do a 14-year note at 5.477% interest if I'm 70 years old. And that note would cancel on my death. And the note itself would not be subject to estate tax on my death, and that's called a skin. And we have more information on skins if you're interested. So we wrote an article, Christopher Denicolo, one of my partners and I, wrote an article called Flexibility in Uncertain Times, explaining the Spousal Lifetime Access Trust to clients. This is in the Thursday report as a draft. It's going to be in the Bloomberg Journal for May in improved form. So please read it and let us know immediately of any typos. There's also a standard letter of explanation that talks about how the SLAT can work. Let me say, we have a lot of slides I could cover, but I'm only going to be here a couple more minutes or 3 more minutes. Let me mention that everybody's real anxious to get their $10,700,000 gift made, but they're so much better off doing a discounted installment sale and keep the exemption to the extent you might need it, in case the IRS comes and wants to revalue your installment sale. For example, if I'm going to do a $50 million installment sale, and the IRS says that what I really did was a $75 million transaction, there's a $25 million gift. I'm not going to have that client make a big gift in the same year, because I want to be able to tell the IRS, well, even if you can shoot through my adjustment clause and shoot through my overflow provision, I'm not going to owe gift tax because I still have most of my $10,700,000 exemption. So for those of you who are professionals, and I mean professional tax professionals, not whatever other profession you may be in, I've got literature here on adjustment clauses, and I also have literature here on the Powell laws, literature on self-canceling installment notes, and page 123, a typical estate plan. An unmarried professional owns a professional practice. Now, this professional practice, if he was married or she was married, could be partly owned by a SLAT. And we've been doing these for medical practices. We found a way, with the blessing of the Agency for Healthcare Administration in Florida, to have a medical practice partly owned by a trust for spouse and children, known as a SLAT. So, for example, if your medical practice pays dividends of $1 million a year and it's worth $5 million, take 20% of that, which is worth $1 million, and gift that to a SLAT. Report it as a gift. Now you have $200,000 a year going to the SLAT, and you're going to pay the tax on that, and that's going to be out of your estate. And then if you can sell that medical practice for $5 million, then another $2 million is going to go into the SLAT. So this can work very well. Let me see if I have any questions here that I can answer. And then I just want to remind you to join us next Saturday at 11. I've got 2 different topics. I'll do a little bit of each. Okay, where is the dummy? Well, the dummy just refuses to work 7 days a week. He's got a 2,200-hour quota, and he's a little bit behind, so he's sleeping in. Okay, what do you think about granting the trust protector the power to add the grantor as a beneficiary to the SLAT? I only do that if certain events can occur. I'm afraid that the IRS will say that the trust protectors had a fiduciary duty to do that. So I know a lot of good tax lawyers are not afraid to have the trust protectors have that power, but I am, at least in a domestic asset protection trust, because you can't be sure if they're going to work unless you reside in the domestic asset protection trust state. What do you suggest for a couple where the wife owns the majority of the couple's assets in traditional IRA accounts? Well, Judith, that's a really good question. The wife may consider putting a promissory note into a SLAT. So you have a $20 million IRA and not much else. Put a $5 million promissory note owed by the spouse into the SLAT and consider that a $5 million gift. Have the note bear interest at 6%. Do some special things that are needed under state law to make the note legally enforceable, including pixie dust. And then in 10 years, that note will be about $9 million that will be out of the estate. The client dies with a $30 million IRA, but deducts the $9 million note and pays less estate tax. Or get divorced and give half of that IRA to your spouse because you really love him, and then he gives the note to you. How does SLAT funding work in a community property state? Thank you, Anil. You transmute out of community property status and then give the transmuted non-community property to the SLAT. California and Texas are the most notable community property states. How to take assets out of a joint trust to fund the SLAT? Carefully. Can siblings be reassigned as trustees to split the gift tax? Do we want for father to pass and the SLAT be assigned to our mother, or reassign siblings as co-trustees if he passes? Well, Amy, probably you want to be the trustee. You want to have control of this SLAT. Your dad did a SLAT. Thank him very much for that. The splitting the gift the question as to whether you can split the gift is not as to who the trustee is, but is as to the likelihood of the spouse taking the assets. So I guess it does help to make the children the trustees, because then the spouse is less likely to receive the assets. Jeffrey says, as an alternative to the special partner member residing in the control trust, can you appoint a manager of the LLC that has those rights and can only be removed and replaced with a successor? Jeffrey, you probably can do that, but I've just been more comfortable with the special voting power. But I agree with you, you probably can do that. But that's really not conventionally how control works in state law entities, but certainly it's easier to do than what we're doing. Okay, do I do estate planning for New York residents? It depends on how the Yankees and the Mets are doing compared to the Rays. But thanks for asking, Laurette. It would be best if I did that I help your New York lawyer. Okay, where did I purchase my puppets? Paul, that's a very good question. I got this one on Amazon. He's about $340. He moves his eyebrows and he moves his eyes, and he can't stop talking with his darn mouth. He has hands, and then you can also turn his head around. It's all controlled in the back here, and it's all wooden construction. Good question. Okay, Teresa, thank you very much. You say this was a very informative webinar. I guess you just don't get out that much, but we do really enjoy giving these webinars, whether you enjoy receiving them or not. Let us know any questions, comments, or suggestions. You've got my email there, or you can send an email to dummy@mcpuckett.com. Thanks to Kelsey, our marketing person, for coming in today and getting this all set up. Have a fantastic weekend, and thank heaven it's almost Monday. Thank you. How do I get out of this?